In this video, guys, we're going to look at why do many traders prefer the short side. Stay tuned. Hey guys, warm welcome to you. Thank you for joining me. All right, so traders generally, a lot of traders anyway, prefer to trade on the short side. So why is that? So I'm going to look at my personal experience with it. I'm also going to kind of cover some of the things that I've seen from other traders and also read from some other greater traders out there. So if you imagine a chart here, right, you've got a standard chart that's kind of chugging up like this, and then the other side you've got a chart that's kind of doing this, right? And if you've been trading for any number of years and you've been trading through some bear markets and stuff, you know that the short side is very often far quicker to move. So what happens with an uptrend chug? Generally, exactly what it says, we get a chug, right? The market kind of goes up, it drives up, and that's fine. If you're long from kind of down here, you can just sit with it and nothing much is going to happen. You're great, you wait, you close it in the day, you close it in the week, then the month, that's fine. It's great for investors, sometimes swing traders who are just kind of buying and holding. But for traders who like to kind of get on the end of moves and rotations, generally this market is far better. We very rarely get this in reverse to the downside. In other words, you very rarely get a chug lower. You often get kind of brutal short covered rallies, then swings back down again. So, and these are quick. So the important thing is that this is why traders generally like the short side, is that the speed of the move is generally quicker. It's one of the things that traders really like, because you kind of often get your short covering rallies in this down move, and then it just turns, and then it just might fall through the floor and do a massive amount of kind of ticks movement or percentage or base point movement in a very short period of time, which means that you're going to profit quicker. You haven't got to sit through stuff. And I often find as well that you're right or wrong quickly. Now, I like that. I mean, that's possibly not the best way to look at it, but I don't know about you. You have to let me know in the comment section below, guys. But I like to know if I'm right immediately or if I'm wrong. I'm happy to get stopped out, and I'm obviously happier that the trade goes in my direction. But what I find frustrating from a personal perspective, or more frustrating, should I say, is a trade that just stagnates and sits there. And very often, if you're buying this because it's slower grind, generally speaking, we'll go on to it in a second, you know, it sits close to your stop, it starts to go in a direction, you haven't really got much of a cushion, and you're well aware that it could take, you know, one little downdraft move and it takes out all your gains. Whereas a short trade, you know, you get the drafts lower, you get these kind of counter trend moves and blast lower, then blast lower. It feels cleaner. You know, and you're right, the volatility tends to be greater during kind of shorter environments and downside moves, which means if you're good at picking these spots, if you're good at kind of finding those opportunities and getting on them, then you're either going to get stopped out or you're right. And of course, the other thing is, I think it's easier from a price action perspective to read it. In the momentum ignition type trades are generally easier to read on the short side, because if you think about the supply demand imbalance, right? Many people the reason the market's going lower is more from fear than is from greed. Now, in some circumstances, of course, our rallies are done by short covering. If you look at individual stocks, you know, if there's a lot of people who are stuck short and it's rallying, then we do get a kind of aggressive up move. But generally speaking, you know, fear comes from people losing money from their investments, from hedge funds who are buying. Most people are long, right? The general consensus is that a majority of people own stocks, you know, whether they're a hedge fund, an investment fund, mutual fund, individual retail trader, and so individual investor, should I say. And so when the market starts going lower, the fear of I'm losing money means that they're far more aggressive and far more worried about getting out quickly than they are price. Whereas an uptrend, there's no panic, right? You're in the money, you're making money. I'll hold on for a little bit longer, but if it starts to come back, and there's no urgency there. They're already in profit. The frame of mind is slightly different. You know, the concern that they're going to be caught out and losing money, and all they can see is losing more money and more money, means that they're far more urgent with their execution than they are worrying about the price they get, which is why we get these heavy downdrafts. So a lot of traders prefer that short side. And as well, you know, we think about stops and where we put stops and placements and stuff. And you know, the standard stop is a stop market order, you know, where you're putting a stop under a low. Let's say we had a low, swing low here, your stop is under there, and people are expecting the market to go higher. So as the market starts to trade through lows, in this sort of example, on this sort of example, we get lots of market orders hitting the price, hitting the bid. And of course, the liquidity is lower as well, because generally people don't want to take on risk, which means that we often get these downdraft moves. And if you're trading those bear markets, we often get, you know, real accelerated moves, especially if you come into like the close of the day or that kind of stuff. Real kind of push, force to the downside, real, you know, real, like there's literally almost no buyers. You just see this thing just crumbling. And it's far easier to jump on that and just see literally, you know, one-way trade, just one-way trade, just selling, and jump on that and be more aggressive on that than it is if you're just plodding up to the upside. And one of the traders actually I talked about before in the book Pit to PC, Louis Borsellino, he would trade in the pit, and in the pit he would be on the short side only. So he would trade on the short side in a slightly different environment back then, but he would kind of add to the position to force the price lower, knowing that the fear of other traders losing meant that they would eventually capitulate, and he would be able to cover into those. So very often that was that, and that was, you know, how he traded. So that's why many traders prefer to trade on the short side. It's a quicker movement. It can be easier to read. They're right or wrong instantly generally. That's kind of something that I've observed as well, as opposed to the long side. So a lot of traders do prefer to kind of hit stuff from the short side because of that. So anyway, that's my thoughts on it. Let me know your thoughts in the comment section below. And don't forget, guys, to check out our channel sponsor. A link to them is in the description below. Hit them up, go and check them out, go on to this, see what they are all about. So take care, guys, get your risk management. I'll see you next one. Bye-bye.